Hello and welcome to the Mutual Fund Guide. It's all about your funds and your returns. I'm Muralidhar Swaminathan. Today on this show we will focus on debt funds. Joining me on the show are Dwijendra Srivastava, CIO, Fixed Income at Sundaram Mutual Fund, Nikhil Kothari, Director and CFP, Etika Wealth Management, and Vikas Puri, Vice President at Quant Capital. Gentlemen, welcome to the show. Thanks for joining us. Let me first focus on debt funds. Debt funds are back in focus as bond yields have seen a sharp fall. From its peak that we saw in September, bond yields are down almost 90 to 100 basis points. Yields fall when bond prices go up. They have an inverse relationship. The price and the yield of a bond is linked to the general interest rate scenario. In a falling interest rate scenario, bond yields will fall. But as far as bond funds are concerned, the NAV of a debt fund can go up. Which funds, how is the big question we will pose to our guests. First I will go to Dwijendra. Dwijendra, before I come to you, I will read out the funds which have gained the most for the benefit of our viewers. Some of them have gained from 7 to 10%, all in a matter of less than 3 months. Reliance Nivesh Lakshya Fund 10%, IDFC GSEC Constant Maturity Plan 9.3% gain, SBI Magnum Consta Maturity Fund 7.7, ICICI Pru Constant Maturity Guild Fund 7.59, DSP 10-year GSEC 7.4, Franklin India GSEC 7.25. There are some other funds there, most of them are guild funds or funds which invest in government securities. They are up by about 6.5. The best gain is about 10% in less than 3 months. Let me bring in Dwijendra. He's an expert on debt funds and he's also the CIO at Sundaram Mutual. Dwijendra, which are the kind of funds that will gain whenever bond yields fall?
So I think the funds which are from mid duration onwards, typically they tend to benefit the most. So the post SEBI categorization, the funds from medium duration bond fund to mid to long term duration bond fund, long duration bond fund, gilt funds. So gilt funds which are again constant maturity funds which are like what 10-year kind of maturity which they maintain, and very long duration fund is like the one which you mentioned, Reliance Nivesh Fund is typically a very long fund and they maintain the maturity. So that is the biggest beneficiary in a big interest rate fall.
Right. In your view, if interest rates continue to fall, that is the kind of perception in the market right now. What are you doing as a debt fund manager? Are you picking up long-term bonds, or how are you managing the funds in this kind of a situation?
So the funds as per the mandate now post categorization, obviously most of the funds you are running in a duration band. So typically also you have to see what kind of move has already happened and how much the portfolio manager has been able to capture. So the funds which are tightly run in a mandate like 3-year to 4-year mid duration fund is a 3 to 4 year, then 4 to 7 year is the mid to long duration fund, and long duration is 7 year and above. So the funds which have already gained because of the duration dispensation, you have already seen. So typically we tend to see moves of about 100 basis point on an average, on a median basis. So as you already pointed out from the top, we have already seen a fall of 90 to 100 basis point. Now the question would be that are we going to see further interest rate drops from here? So that is the question the fund manager will ask, and also another question which the fund manager need to answer is that if this is going to continue, how long this will continue. So I think these are the questions which the fund manager will ask and accordingly position their funds as per the mandate in these kind of funds.
Right. For your own fund house, which are the kind of debt funds that you have, and what's been the kind of performance, and can you take our viewers through your own funds?
So we have from a duration perspective, we are like a short duration fund, which is a 1 to 3 year kind of. We are not present in the long duration category as of now. So post categorization, we have been out of most of these fund categories which you have listed out and which have benefited out the secular downtrend on the interest rates, and we were adequately positioned for the funds which we were running. Like we have short duration fund, we have mid duration fund. The mid duration fund is about 3.2 kind of duration, which we are Macaulay's duration, which we were running, and they have done reasonably well in this kind of environment.
Right. In all these funds, is the focus of investment on government securities, or do you also have other bonds and other debt instruments?
We do not have a gilt fund. So gilt fund is exclusively focused on the government securities. On a mid duration fund, we have we can take up government securities as well and corporate bonds. So the majority of the holdings are gravitated towards corporate bonds. So we have a very marginal holding on the gilts in medium term fund.
Right.
On a short duration fund, again we have a marginal holding on government securities, because these are the funds which typically take small incremental risk.
Right. Dwijendra, hold on to your thoughts. I will come back to you and discuss a little more about the dynamics of the bond market and where are the bond yields headed. I'll take a slightly more broader perspective from you. But for the sake of simplicity, let me bring in our two advisors, Nikhil and Vikas. What are you advising your clients at this point in time? There has been a good rally in this funds, in as much as from where 6 to 10% gain in a matter of 3 months. Do you think they should book profits, come out and switch, or stay invested?
So typically I'll say this type of funds, the one which you mentioned, is more of a trading call. They are more like gilt funds. So gilt fund, your entry and exit, long-term gilt fund has to be very, very perfect, because these funds are very volatile. If you look at last year when the yields were going up, this fund were giving very low return. So this fund is like a trading call where your entry and exit has to be very, very important. Now someone who have entered at a yield of around 8% would have easily seen a drop of around 100 basis point, and we see return of 8 to 9%, which you rightly mentioned. Incrementally from 7.25%, how much yields are headed down, the answer will be typically that now the upside is little bit less as compared to what it was earlier. So at this point of time, I'll say that incrementally people can start booking profit. You may have a rally may continue for another 10, 15, 20 days, and this is more primarily not because of interest rate coming down, but primarily because of RBI not hiking rates and the OMOs which were done by RBI. So there are a lot of OMOs which are done by RBI, which has brought the yields down, and most of the people were not as a bullish on the yield market, so they were anyway under invested. Right. So that has led to the whole rally on the whole GSEC yield. With the incremental flow, I'll say corporate bond fund is a better bet as compared to
shift from gilt to corporate bond.
Yeah, because the spread between corporate bond fund and the gilt with this whole rally has increased tremendously. Okay. So the AAA bond are still quoting at 8.5%, whereas now GSEC is at 7.25%.
Right.
So now we have the spread is 125 basis point to 150 basis point and plus. So I'll say that now it's good time to move from a pure gilt fund and to move pure corporate bond fund. And that I think if whenever the yields interest rate start coming down, they will benefit more as compared to pure gilt fund.
Yeah. What's your advice?
There is basically range of 6.45, 6.5 in 18 months period to 8.23%. So there is a huge spread. Now from here also there is a scope that you had a 6.45 roughly 18 months back. So if interest rate in US hold down and there is no further upside on the interest rate hike, then probably if interest rates stay here, or they can go further down. So idea is that as he mentioned that don't invest now, but those who are already invested, they can maybe wait for some more time and book profits when the yields further come down.
Right.
So that we can do.
Yeah, thanks for that view. Very interesting points. Let me take this question back to Dwijendra. Dwijendra, how do you see the corporate bond market itself? Like the two financial advisors mentioned, that spread is there. Do you think that spread will continue to widen? given that liquidity supply is suddenly there are floodgates have opened and FIs are also investing in gilts, do you think it's a good idea to stay invested in corporate bond funds and invest more in corporate bond funds?
So yeah, I mean, if you compare the fall in the interest rates on the government securities, there has already been a front-ended move on the government security, and that typically happens in the market. We have seen in earlier cycles also. It's difficult to first move happens on the government securities, and eventually you see that percolating down to the corporate bonds, and the spread of anywhere between 80 to 100 basis point in the various tenors is pretty attractive, because the accrual spread, assuming the credit quality remaining constant, is a pretty decent spread to preclude any mark-to-market movement which may be there. So it makes a lot of sense to hold on to corporate bond funds rather than government securities fund. Also, the government securities typically tend to be more volatile, and as rightly put by the reason why we are seeing a good fall on the interest rate is, one is the US has not cut, is likely not to raise rates so fast, possibly, or maybe we see a last rate cut today and they hold on to from there on. And the OMOs conducted by RBI, so induced liquidity into the system, the amount of 50,000, the amount also have been dynamically being managed, and that has been an outcome of the liquidity conditions in domestic market, if you look at it. And if the conditions change, obviously this could warrant a reduction in OMOs, which could have an impact on the government securities.
Right. Dwijendra, stay with us. I'll take one last question before we take queries from our viewers. Where do you see the bond yields going down further? Will they go to as low as 7%?
Yeah, I mean, I think 7% is, it can happen. We are already at 7-quarter levels. We are about 7 quarters, 730 band today. And in case there is a perceptible slowdown in the global economy, which can happen, the oil price already is hovering at around $55 to $60 band. Due to any reason, I mean, you see oil prices moving down. So all the things have been worked on. The rupee already has appreciated, acknowledging the impact of oil on the current account and the trade deficit of India. So I think that clearly means a 7% or 7.10 can be something which could be achievable in the near term.
Right. Very interesting. Bond yields. When we say bond yields, it's the Government of India's securities which have a 10-year horizon. For the benefit of viewers, let me say, when bond yields are falling, your NAVs will go up because the bond prices are going up. So we are addressing this question, what to do with the debt funds. Clearly the advice is that stay invested in corporate debt fund. On that note, I'll slip into a short break. We'll come back in a few minutes and take more queries from viewers. Stay Mutual Fund Guide. Let me go to the first caller. Lalita is on the line from Bengaluru. Good afternoon, Lalita. What's your query?
Good afternoon, sir. I'll tell you my objective. My objective is to accumulate a wealth of around 8 crore rupees at the end of from 18 years from now.
Okay.
So for that, I'm doing an investment of around 20k in stocks and 18k in mutual funds. Every month I'm doing this. So I'll tell you my investment in mutual funds. Like I'm investing 5k in SBI mid cap fund, and another 5k in Reliance small cap fund, and 3k in DSP BlackRock natural resource and energy fund, and another 5k in Motilal Oswal multi cap 35 fund.
Right.
So I wanted to know what more should I do to accumulate the wealth, whatever I said before.
So 8 crore is for how many years can you stay invested?
18 years from now.
18 years from now you can stay invested, and your target is 8 crore. She's got a bunch of 8 funds. Who would like to address her query?
Yeah. So first of all, to accumulate a corpus of 8 crores, the SIP which she is doing right now will not be sufficient. She has to increase the SIP amount
By a large amount.
Yeah,
Yes.
but the question is that so it's not about ultimate objective, but the good part is that she has set a goal in place that she needs money for her daughter's or son's education, which after 18 years age, and after 18 years the fund which is selected are equity fund, which is a good option to select in. What I'll recommend her that the SIP she's doing, she should continue, and incrementally every year as her income increases, her SIP should also increase. So what we say is SIP top up. So when your income increases by 10% every year, your SIP should also increase by 10% every year on year, which will make sure that her corpus is achieved over a period of time.
Now, how much is the gap right now?
So if you calculate now 18,008 crore she would make in 24 years if you take a IR of 15%. So she has to take it up to 33,000 month on month. But she's saying that she's investing in direct stocks. She has other investments also. So obviously the entire calculation changes, because if you club the existing corpus, then obviously the number of years will come down.
But the funds are good.
But funds are good, yeah. But then I think DSP natural resources she should exit, and maybe she converts DSP top 100, because the CAGR for top 100 is 20%. It's a diversified fund. Right now she's into more of a sectoral or thematic fund, and the fund has not done good. In last 1 year it has given minus 14%.
Right.
So I think switch from DSP natural resources to DSP top 100, and add couple of large cap funds in your kitty.
Large cap or multi cap? What would you advise?
So I think see she has
doesn't have a multi cap. No?
She has one little concentrated Motilal Oswal fund, but she has a small cap fund. So I think it should be kind of complemented by a large cap fund.
Right.
So that way she.
Lalita, you got the answer?
One more thing I would like to tell you, all these investments I started around 1.5 to 2 years back. I'm a bit aggressive because whatever the money I had saved before, I lost every penny of that. So just like everything I started around 3 years back, like from zero we have started. So that is why I need a clarity on this. Like how much more should I invest to meet my objective? Like this, in my objective is to accumulate 8 crores, which should take care of my daughter's education.
Absolutely.
And her marriage and our retirement also.
Sure. She wants more clarity on.
Yeah, so what I'm saying is that, see, right now you're already doing an SIP of 18,000 rupees. You need to keep on increasing. As you see, if your target is very clear that you need 8 crores by the end of 18 years, then your SIP amount has to be 33,000, which may not be possible at the current juncture. So what I'll recommend is that how you normally do your investment is that with the help of SIP, increase your SIP every year on year. With regard to funds, as you rightly say that you have a natural resource fund, you need to change that. Ideally, you should have a 4 to 5 funds in your portfolio. That should be good enough from a diversification perspective. SEBI has clearly done the mandate in terms of categorization. You can have one large cap fund, which is rightly recommend DSP top 100. You already have a multi cap fund, which is Motilal Oswal multi cap fund, and you have a small cap and mid cap fund, which is SBI mid cap and a Reliance small cap. Now you can continue investing in this fund. Now, as we rightly said, that you need to have patience when you're investing in equity, because in the short term it can be volatile. So if you look at last 1 year return, most of the fund would have given you negative return. But the idea is that in equity, you in a period of say 5 years, you'll have one very bad year, you'll have 2 average year and 2 very good year. So you don't know which year will be what. So the idea of SIP is always that you keep on doing investing every month on month. So you average out your cost, and over a period of time you can make a handsome return. And just the main idea is to be disciplined and stay invested.
Right. All the best with your investments, Lalita. The next caller has been waiting by patiently. Mr. Kamlakar is on the line from Nagpur. Good afternoon, sir. What's your query?
Good afternoon, sir. My query is that my annual income is about 25 to 30 lakhs. That is 2.5 lakhs to 3 lakhs per month. I've invested 60 lakhs into mutual funds, primarily into HDFC hybrid equity, 30 lakhs, HDFC large cap equity, 15 lakhs, mid cap, 10 lakhs, and Tata Retirement Moderate Fund, 5 lakhs.
Okay.
I would like to grow this fund to about 3 crores in coming 5 to 7 years. My age is 70.
Okay.
So how should I go about it?
Right. Very clear objective, very clear planning.
Correct.
And 10 years he wants to grow his corpus to 4 to 5 crore.
Yeah, so I have couple of observations here. First of all, you are heavily exposed to one fund house, so I would recommend that you add more fund houses in your portfolio construction. Now, my one question, sir, is 2.5 lakh to 3 lakh income is also contributed by the 60 lakh which you have invested in these funds? Are you taking a dividend out of it?
No, these are all growth funds, and my income is primarily from the tax-free bonds, perpetual bonds, pensions, rent, etc.
Fair enough. So now, see, I have just calculated at the rate of 12%. So if you invest this 60 lakh, yeah, at a CAGR of 12%, your corpus should be 1.9 crore in 10 years, which is below the target. And so now another question was that out of that 2.5 to 3 lakh, can you save at least 1.5 lakh month on month? I mean, if your monthly expenses are met within that 1
lakhs per month, I can save up to 1 to 1.5 lakhs.
Fair enough. So that will suffice your requirement. Now what happens if you invest this 60 lakh and then do a SIP of 1 lakh? In next 10 years you should be sitting at some 4.5 crore. So it will meet your target. Now I would recommend that you can prune down your HDFC exposure. Keep HDFC Mid Cap Opportunities Fund. It's a good fund. It's a bit aggressive, but it's a good fund. Stay invested in Tata Retirement Savings Fund. Just add ICICI Pru Balanced Advantage Fund and add couple of large cap funds in your portfolio. And if you are sitting in growth, then it's a good call, because right now what is happening on a dividend payout option, lots of funds have not done well, and out of their principal only 10% dividend distribution tax has been paid by these investors in the monthly or quarterly dividend payout options. So it's good that you're sitting in growth funds. And one more thing, in case you need any kind of cash inflow or any income requirement, then better to add one ultra short term kind of fund, maybe a Franklin India ultra short bond fund, and then do a systematic withdrawal plan to meet your regular inflows or income. So don't get into dividend payout options. That's my recommendation.
Right. All the best, Mr. Kamlakar, with your investments. We wish your target of 4 to 5 crore is achieved well within the time that you have set. And let me go to the next caller. Priya is on the line from Bengaluru again. Good afternoon, Priya. What's your query?
Yes, sir. Namaste. My query is, I want to invest in SIP every month for the tax savings and for the profit making. So I would like to know about a good companies to invest in. It may be a mid caps or small caps or whatever it is.
Right. You are saying your objective is tax saving as well as make profits. What's the kind of amount that you want to invest? I will toss the question to Nikhil.
Yes, sir. Minimum 10,000 and I can extend as well.
Right, 10,000 and she can also increase.
So primarily if you are looking at tax saving under section 80C, then the only option what you have is called as equity linked saving schemes in mutual funds. So basically what it says that you can, when you investing your money under section 80C up to 1.5 lakh, you get tax benefit. The good idea is that when you are investing in equities over long period of time, it will also generate wealth for you. So on the tax saving fund, I'll say that you have couple of options. You have DSP tax saver fund, you have Access long term equity fund, you have Mirai asset tax advantage fund. Out of this one fund, you can choose any one of those fund and just continue keep on doing your SIPs. If you do a 10,000 rupees SIP in a year, if roughly you're doing 1,20,000 rupees investment, which will help you also to save tax under section 80C.
Right. So does that answer your query, Priya?
Yes, sir. Yes, sir.
Okay. Good luck with your investments, and good luck to all the viewers who keep calling us. Nikhil, Vikas, thank you so much for helping our viewers save, invest and prosper. That's all for this edition of the Mutual Fund Guide. More news and updates on the other side of the break.